Well, 2025 has started off a little more volatile for a lot of reasons. This week, we're going to talk about 3 reasons why we can stay positive in our outlook for U.S. stocks. I've been sensing a lot of angst in client conversations over the last couple months, and I completely get it. We have a new political regime in place. There's uncertainty in the marketplace. We certainly understand that the news media isn't going to tell us much, if anything, that's positive going on in society. But if we throw that aside, throw the emotion aside, and talk about the actual data that we're seeing in the economy and in the market, it may paint a slightly different picture. So as I said, we're going to focus on 3 reasons why I feel, and our fellow partners feel, that this could actually be a positive year for U.S. stocks when it's all said and done. Now we're going to start off with reason number 1. A large number of analysts actually feel that U.S. stocks will end the year positive for the S&P 500. You'll see on this first slide that we have 28 of the large analytics firms represented, and what we're looking at is their year-end outlook for the U.S. stock market, the S&P 500 for 2025. What I noticed right off the bat is there's a lot of positive numbers. Of the 28 firms represented, 25 of these firms think that we will end 2025 with positive returns in U.S. stocks, and of those 25 that think positive returns will occur, over half of them think that we will see double digits. Now, I don't have any idea whether or not the market will end up, especially up double digits, but what this is telling me is the consensus is the economic data still seems to be overwhelmingly positive right now. As we know, there's a lot of things that can throw predictions off, and I often say that analysts are a lot like weathermen. They make a prediction and then they may change it along the way. But that doesn't discount the fact that overwhelmingly, most analysts believe that we are still in the middle of what's called this bull run, where stocks are going up over an extended period of time, coming out of the bear market bottom that we experienced in October of 2022. And to that point, that will take us to our next slide, showing that currently we are 2.3 years into this bull market after the bottom in 2022. And on average, if we look back over the last 8 bear market bottoms since 1973, stocks tend to stay in this quote-unquote bull run for over an average of 5 years. And that ties right into the thought of a lot of these analysts on that previous slide that we noted, thinking that this could be another positive year for markets. And that leads us to the next reason why we could look at this data and paint a picture of strong economic activity in 2025. So there's a couple of points that I want to highlight, and this comes directly from Goldman Sachs and does a deeper dive into what they look at economic stability and positive economic indicators. And that starts with the consumer. We're going to talk about the misery index. And yes, that's a real thing. Since 1978, the misery index has been worse than it is today 80% of the time. So what that means that the consumer reality is actually in a very solid place. Next is household wealth. Since 1954, when we look at wealth as a percentage of disposable income, we're in the 98th percentile over the last 70 years. Third on the list is profitability. 29% is the average net margin of the 10 largest S&P 500 companies. And for comparison purposes, that profit margin of 25% is compared to in 2000, it was 11%, and in 1973, it was 10%, 2 other time frames when people were really worried about the economy. And last but not least is consecutive months of positive current activity indicators. And for those of you who don't know what that is just an indicator of economic activity, sales, production, employment, and we've now had 25 consecutive months where the economy is positive from an overall standpoint. So we focused on the data, and as you can see, there is a lot of data points that lead to a conclusion that we could see some pretty stable market activity over the next 12 months. That does not mean that we won't have volatility. That does not mean that there won't be scary headlines that maybe make you feel like things aren't going in the right direction, and that's why we stay the course. We've talked about this over and over throughout the years when it comes to scarier times. For those of you who are in the accumulation phase, this is a wonderful opportunity to just keep putting those dollars into your portfolio and take advantage of some of the dips, take advantage of the volatility. For those of you who are in the distribution phase, if we've done our job here at 10 Capital, done the financial planning, and got you into a portfolio that is going to focus on meeting those long-term income needs, we shouldn't have to worry about the volatility. And that leads me to my last chart of the day. The only wrong thing to do is nothing. We're only looking here at a hypothetical portfolio value if you put $12,000 into a portfolio between 2000 and 2025. Now, if you timed the market perfect and invested $12,000 each year at the very bottom of the market, you can see that that would lead to about a $1.77 million portfolio. On the opposite side of that, if you invested that $12,000 at the top of the market each year, sure, you didn't have that same return, but you still had $1.359 million when it was all said and done. Those two scenarios, compared to that last light blue cash-only chart on the right-hand side, tells the story. Stay invested. Don't let emotions get in the way of that long-term plan that you have. And when the rubber meets the road, if you can take all of the math that's going on in your financial life, match it up with the emotions you're feeling at any given time, and create a long-term plan that's suitable for you, we can block out the noise that surrounds us in the news and that we're hearing from our friends and stick to the plan. As always, thanks for taking the time with me today, and have a great weekend.